Hey everybody, welcome back to Matrix Markets for the weekly analysis, the week ending March 17th. Happy St. Patrick's Day. I'm actually recording this before the markets have closed, as I will be out of town this weekend and unable to post an update. I just want to take a brief moment and remind you to hit the like button and subscribe. You can also follow me on Twitter at Mr. J. Thomason. And you can subscribe to my weekly free newsletter at befinanciallyfree.substack.com. So wanted to mention those things. Now, I've got Bitcoin up on the chart right now, and here we are on Friday, and the markets are once again very interestingly trading in true risk off, because you've got bond yields dipping pretty hard to the downside, both the 10-year as well as the 2-year. The 3-month yield curve I'll talk more about, or the 3-month treasury yield, I'll talk about that in just a moment. So treasuries have typically been true risk off over the last 40 years. This is something Michael Guyed has talked about quite a bit on Twitter, and if you go back and you do the research, you do see that treasuries tend to be a safe haven play. You also see gold, which today is up over 3%, up over $63. It has gotten as high as 1985, I believe, on the day. Let me see. 1987 on the day. So, and gold has actually cleared. It's actually sitting right at the next resistance, which I don't actually have marked. This is right at resistance with gold. But above this level, the next resistance is the old all-time high, which we got to back in 2020, and so risk off big time here. What's interesting though is dollar is selling in this situation. Dollar is still bearish on a technical basis. If I pull up the conditions backdrop, we're in bearish conditions, so just want to point that out. So it's not surprising to me that the dollar would be biased to the downside, but it is interesting to see that the dollar is getting sold. I think I'll try to explain why in just a moment, but I do want to mention, so gold and treasuries are trading risk off, but then when you think about Bitcoin being up $1,700 today, and basically ever since the close of trading on Friday, when there was all the uncertainty about the banks, Bitcoin is up, since last Friday, Bitcoin is up over 30%. And so Bitcoin and to some degree gold and the dollar are playing on increased liquidity, or that's what they're trading on, is the increasing of liquidity in the system. And so I want to point out, a lot of people have been showing this chart from the St. Louis Fed database online. And if you obviously this is going back to early 2000s, but if you go only to this year, then let me do the last 5 years. Let's do this. What a lot of people have been pointing out is that as of this last Wednesday, they updated it. In 1 week, the Fed has basically undone all of its QT that has been doing since November. That's the level that we're at right now. And so a lot of people are posting that and talking about how, nominally this is one of the largest increases in liquidity that we've seen. But doing this on a nominal basis is not really helpful. And the reason why is because of inflation. Obviously, I don't have the, actually should have pulled it up. I don't have the inflation chart up, not the percentage year over year, but if you just pull up consumer price index and you look, it basically is just a line that goes straight up and to the right. So a lot of people are pulling this chart up to show you how big that move was. But one of the things that you could do on the Fred chart is you can do it in terms of change. So I've seen this posted a lot, the millions of dollars. And so again, this puts it a little bit more into perspective because the total change is not quite at the level of the COVID crisis, but it is higher than the GFC. But the actual way that you should look at this is the percent change. And when you move it to percent change, then this is very small in comparison to the COVID crisis as well as the GFC. You saw the same kind of thing take place in 2011 when you had the debt ceiling issues. You saw it at not quite as high, but at a similar level in 2019 after the repo market failed. And so one of the things that I've been highlighting on Twitter, I don't know if I have the tweet at the ready, so excuse me for just a moment, but I posted this tweet where I was talking about how I was using, the GFC as the proxy here. The spike that you see in liquidity comes right at the time that Lehman collapsed, but that wasn't the market bottom still for a couple more months. It took another 6 months almost for the market to bottom. And so I just want to point that out to people who are, talking about this injection in liquidity as something to cheer about, because and as something to start mooning Bitcoin and risk assets on. And I'm not saying that, I'm not here to tell you that Bitcoin is going to go down to 10,000 or lower. I'm not saying that, but I am saying that this rush to jump into Bitcoin, because I think one of the things that has happened is that various individuals have been using the Fed balance sheet as part of a metric for net liquidity. And what a lot of people have been posting on are these net liquidity charts, and I have posted some of these too, where people say, hey, if liquidity goes up, then Bitcoin usually either leads it or follows it or something like that. And so a lot of people are taking that as the sign that they need to go into Bitcoin. And I'm not going to, who knows what's going to happen, but all I would say is that just because the Fed is injecting liquidity and is taking more on their balance sheet, that does not necessarily mean that it's positive and that risk assets are going to go up from here. So it's interesting. So I said gold and treasuries are acting like risk off. Bitcoin and gold and the dollar are trading as if it was just about liquidity. Equities are down on the day, but you can see the NASDAQ's trying to fight back. The S&P is trying to fight back. I do have the NASDAQ at a really important level from resistance. If you take the August high and then go to the February high, we kind of wicked above, but we're getting rejected right now. On the S&P 500, we are below some of the important, the tide line, basically, which is what I've been watching to see if that would happen. The NASDAQ, interestingly, is probably it's going to close above the tide line again, which I was wondering about. But you're just seeing lagging in the Russell, you're seeing lagging in the Dow, and I just don't know that bodes well. You've got the VIX, which is right now fighting with the 25 level. We've wicked up a bunch of times. We're on a huge OPEX, and there's a lot of uncertainty going into next week. Right now, the market is basically pricing in a 25 basis point hike. I actually just earlier today, posted that I actually am starting to think that they won't hike. And the reason why is because when you look at the 3-month treasury yield, if you put the Fed funds rate on the chart with the 3-month treasury yield, then basically you have the federal funds rate follows the 3-month treasury yield. And I had thought that maybe they would still get a hike in, but now the 3-month treasury yield is below the federal funds rate. And so well below the Fed funds rate. It's as long as it's below 4.5, then it's low enough that you basically, the bond market is kind of, as much as people are saying that it's right now, I think we're 80% or more odds that it's going to be a 25 basis point hike. But the 3-month treasury yield is telling you no, that they're not going to hike. And if they don't hike, that's going to be problematic, because it's going to maybe show you that something is not so good and that the Fed is willing to stop hiking because they are concerned about what's going on. So I do want to call that out. A couple of pieces of data I wanted to look at. If these are the Conference Board economic indices, so you've got the leading, coincident, and lagging economic indices. Sorry about that bell there. You've got the leading economic index once again making positive developments on a rate of change basis, and the coincident and lagging economic indices are doing just fine. So I don't know, like the economy is still in a pretty decent place, and then inflation is still well above target, both on year over year and on a 3-month annualized basis. Actually going the wrong direction on a 3-month annualized basis versus previous months. And so, and then like median CPI, the year over year median CPI keeps going up. This is the second month in a row that it has printed higher. And so, like, what's Powell going to do? Like, if they, I would imagine if they don't raise rates, that it's going to basically, I mean, maybe they'll pause just to see what happens with, with the economy over the coming weeks. Maybe they'll pause and then continue hiking again in May or something like that. But if they don't, then, well, I mean, if they do pause, the markets are going to go crazy. The markets are going to probably pump at first, even though a pause is not necessarily a good sign. So these are all tail risks that you should be aware of. I definitely wanted to also point out, let me see here, on gold, if you pull up various oscillators and other metrics, then gold is actually very, very overbought. And so you're actually seeing it just in the time that I've been recording. It's come off about $8 or $9. And so you just want to be aware that that is getting a little bit overbought. And so you either need to hedge your downside before the close here, or, well, which by the time you guys see this, it's going to already be closed. So the best thing to do would be to trim some or hedge your downside. Because depending on what happens next week, we could see some volatility. We could see some correction to the downside. So you just want to be prepared for that. Anyway, these are the big things that are happening this week. And we've got obviously another great weekend ahead. And so stay safe this weekend. Hope you guys have a good weekend. And I'll see you guys next week for another macro important week. See you guys next time.